Hello. I want to talk to you about a crucial question right now. Where should you be putting your money in 2026? This requires a clear-eyed assessment of risk, a disciplined search for value, and the emotional fortitude to be patient. The market today is exhibiting high enthusiasm, but I can tell you that my company, Berkshire Hathaway, is exhibiting extreme caution. We have been a net seller of stocks for 12 consecutive quarters, and our cash and short-term U.S. Treasury reserve has hit an unprecedented record high of over $381 billion. That is not a number to brag about. It is a sign that the investment environment is dry. We simply cannot find wonderful businesses at a fair price. If I were asked today, as we stand on the precipice of 2026, where the three best places for money are, they would be assets that embody safety, quality, and optionality. These three assets are my top three choices for your money. In 2026, I ask you, does your current portfolio reflect the market's greed or your own sound valuation? The first and most important choice is where you establish your ultimate financial fortress. This is not a choice for growth, but a choice for the preservation of your purchasing power and the preparation for future offense. Short-term U.S. Treasury securities, the zero-risk option, this is the bedrock of my company's current strategy. My massive cash pile is not sitting in a checking account. It is predominantly parked in short-term U.S. Treasury bills and equivalents, which are backed by the full faith and credit of the United States. They are the safest asset in the world. This asset choice is powerful because the high interest rate environment has made T-bills a compelling investment for the first time in over 15 years. Data point 4, the Federal Reserve Fed funds rate November 2025 is 5.75%. The high Fed funds rate means that short-term treasuries are currently yielding an extremely attractive rate, often near 4 to 5%. This safe, risk-free return more than beats the expected rate of inflation, ensuring that your capital preserves its purchasing power while you wait for a crash. This is the difference between passive, losing savings, and an active, high-quality reserve. Furthermore, this safe yield highlights the utter insanity of the corporate credit market. Data point 5, spread between high yield and Treasury bonds, November 2025 is 350 basis points, historically tight. The market is only paying you 3.5% extra to buy junk debt, which is facing a 6.5% default forecast for 2026. This is a terrible trade. You must not risk your principal for an extra sliver of yield. Take the 4 to 5% risk-free return and wait. Don't follow the crowd. The crowd is still chasing that last risky dollar. I am simply getting paid handsomely to wait for the pitch I want to swing at. Hit the like button if you currently hold high-quality T-bills or T-bill funds. Comment your safe yield below. My question for you is, are you getting paid a generous, risk-free rate to be patient? The second best choice is an asset that can compound wealth regardless of economic cycles and is resilient to the inevitable credit crunch. This is the quality I look for in any long-term equity investment. Businesses with durable pricing power and low debt, the fortress balance sheet. In an environment of record corporate leverage and volatile consumer spending, you must own companies that are masters of their own destiny. I look for the two hallmarks of a fortress business: a powerful, durable, competitive moat, and a low need for constant, massive capital expenditure. These businesses possess an enduring competitive advantage that allows them to raise prices on their products or services without losing significant market share. This pricing power is the only true defense against persistent inflation, which remains a long-term risk due to massive government debt. Data point 8, Consumer Confidence Index. November 2025 is 95.5. falling from 105 in Jan 2025. Falling consumer confidence signals that corporate revenue growth is going to slow, which will crush companies that are over-leveraged and have thin margins. I want the businesses that can raise prices to offset rising costs and continue to generate predictable, recurring cash flow. Think of essential services, trusted brands, and dominant platforms. They are also not reliant on the dangerous corporate credit market. Data point 1, U.S. corporate debt to GDP ratio Q3 2025 is 52.8%, record high. I want companies that are not part of this problem. I want the ones that generate superior returns on invested capital and can fund their own growth internally. When the corporate debt bubble, the junk bond meltdown of 2026, causes panic, the stock prices of these wonderful businesses may temporarily fall, but their intrinsic value will remain intact, giving you the opportunity to buy quality at a huge discount. Value is greater than hype. The hype is always about the speculative, high-growth, high-debt company. The enduring value is in the quiet, dependable fortress business. Subscribe now to the channel and hit the bell notification for true risk signals. We must focus on the fundamentals. My question for you is the business you own a compounding machine or a financial grenade waiting for the fuse to burn out? The third choice is an asset that benefits directly from the fear that the current market environment is creating. This is a tactical, credit-based play. 3, select short duration, A-rated corporate bonds, the flight to safety asset. While I am avoiding the high-yield market entirely, I see a clear tactical opportunity in high-quality fixed income. I am talking about investment-grade corporate bonds, specifically those from A-rated or better companies, and only those with short duration. These bonds are issued by fortress companies, the very ones I want to own as equity, which have incredibly strong balance sheets and very low default risk. They are senior in the capital structure. Their current yield is attractive, often near 5%, which is competitive with T-bills, but offers a small, safe premium. The key is the safety of the principal. Preservation of capital is priority number 1. Short duration A-rated bonds ensure your capital is preserved while providing a predictable stream of income. The short duration protects you from the risk of rising interest rates should the Federal Reserve be forced to keep policy tighter for longer. The investment thesis here is simple. When the high-yield market inevitably collapses, there will be a massive flight to safety. Data point 2, high-yield bond default rate forecast for 2026 is 6.5%. As high-yield defaults surge towards 6.5%, investors will panic, flee the collapsing junk bond market, and pour money into high-quality investment-grade bonds. This flight to safety will increase the demand for these bonds, potentially driving up their prices and compressing their yields. By owning them now, you position yourself to benefit from both the generous coupon yield and the eventual price appreciation during a period of market fear. This is an intelligent, low-risk way to deploy fixed income capital. Please share this video with a friend who is holding an investment-grade bond fund. Help them understand the importance of quality and short duration right now. My question for you is, does your fixed income portfolio offer a predictable income stream with a near certain recovery rate? To summarize, your strategy for 2026 must be anchored in 3 core assets that reflect discipline, value, and an understanding of market mechanics. First, T-bills, to preserve capital and purchasing power while paying you an attractive return. Second, low capital intensity businesses to compound wealth without relying on the shaky credit markets. Third, short duration, A-rated bonds to provide superior, safe income and benefit from a flight to safety. Don't follow the crowd. The crowd will be ruined by chasing junk yields and overpaying for speculative growth. You must be prepared to be the one who steps in with liquid, high-quality capital when the corporate debt bubble, the junk bond meltdown of 2026, creates the panic. I urge you to use the current high-rate environment to your advantage. Your T-bills are your financial insurance, and your high-quality businesses are your long-term compounding engine. The greatest asset of all is a mind that can think clearly and independently when the world around it is panicking. I ask you now to smash the like button if you are committed to high-quality assets. Subscribe to the channel and hit the bell for more warnings like this. Comment high quality if you are aligning your portfolio with these 3 assets. And please share this video to 3 friends you care about. If you want a free guide, you can get my margin of safety guide in the description below. Stay safe. God bless. My final question for you is, which of these 3 assets are you going to analyze first to protect your money in 2026?